This is Ken Segal, partner and head of business advisory services at LGA. And today I have the immense pleasure of interviewing my friend, colleague, and real estate sensei, Don Hause, who's a managing director in the private client group at Thompson Hennessey and Partners. Don, how are you today?
I'm good, Ken. Thank you for the kind introduction.
Pleasure. Yeah, what I love about Don and his expertise is not only does he serve as an advisor in the commercial real estate space, but he's also a capital markets person, which means he can actually fill the orders that he's advising on. And so far, I haven't found a square inch in Metro Boston that Don doesn't know the history of. So he's a great resource for me.
Thanks again, Ken, and same to you. You're a tremendous resource for all things um, we have with our business clients, and you're a great catch-all advisor. And like the fact that you come in agnostically, but also can implement a solution. So I love working with you.
I appreciate it. So those kind words behind us. I guess the first question I have, Don, is that the world is cyclical, markets are cyclical, real estate markets are cyclical. It doesn't seem like people complain when things are on the rise, but when things are on the downturn, they tend to get a little more utsy. Why is it, do you think, that people get shocked with the downturns in cyclical sectors?
Well, I think they get complacent, and there's a couple of things. One is um, unless you're in the real estate industry, you aren't acutely aware of what's going on most times. For example, what's happening now in the real estate market, most people aren't aware of it. This is not like the 2008, 2009 recession that was generated through the mortgage crisis, which affected everybody. This is more akin to the 1990, 89, 90, 91 recession, where it affected the real estate industry, which has got its tangential effects on people, but they don't readily see it. So I guess to answer your question is when the general public is aware of it, they become acutely aware of it, but there's sort of a benign sense of, I don't really know what's happening, so I'm not as focused on it. And it's easy not to be focused on commercial real estate when the market is going through the roof. Everyone just becomes complacent and it's business as usual. That's not the case today.
Yeah, that's interesting because it's not fair, and I've been through similar downturns as you have. It's not fair to compare everything to what happened in the 2007 era because that was such a seismic change relative to so many other downturns. There's still downturns nonetheless, but they don't have to be as far and deep and wide as what we had back then. That makes sense. Um, Before we kind of jump into the deeper commercial real estate questions, there's two basic sectors. One is commercial, one is residential. Do you find them generally moving in tandem? So when we talk about the real estate markets, are they generally in the same kind of cyclicality and same range, or should we really think of them separately?
I think of them separately. Residential market is driven by liquidity, and there's still a lot of liquidity in that sector where there isn't as much in the commercial real estate market. So they're related, but they're separate and distinct. And in particular, as it relates to what we're going through now, I think the residential market is lagging the commercial real estate market, substantially at this point.
As far as the general state of the commercial real estate market, for the benefit of our viewership, why don't you kind of broadly describe what you view as commercial real estate as opposed to other sectors and kind of where you think it is now relative to a year ago?
Sure. So commercial real estate is all essentially non single family homes. So even a multifamily 12, 14, 16, 240 unit apartment complex or condo complex is still considered commercial. So industrial, life science, office, retail, all non sort of single family homes is generally considered commercial. And there are three very dynamic, I guess, negative factors happening right now in the market, commercial real estate market, affecting everything. The increase in interest rates, inflation, and as you can see in the image behind me, the fact that many companies are struggling with excess space and the hybrid workforce are dramatically negatively affecting the value of all commercial real estate. And some sectors are, the values have decreased more than others, but there is a definite decrease of values across the board.
I've heard like education is somewhat not as affected by cyclicality, to some extent, healthcare and whatnot. But yet, kind of tell me some of the sectors that are, more affected and less affected by what's going on.
Well, certainly the commercial office market is probably the one that's most visibly affected. Now, what's interesting is the statistical effects of that are not yet seen. And what I mean by that is many companies still have 3 or 4 years left in their leases, but they're looking to downsize their space, yet they're still obligated to pay the rental rate for the space they committed to. So the company may be struggling, but that asset may not be experience negative cash flow. Where there's going to be a quote reckoning, if you will, is when the loan on that property matures in the next 2, 3, 4 years, and that owner needs to refinance the property. It will be having to do so at much higher interest rates, and probably in a building where the tenancy is downsizing, they need to reduce their rent. So at that point, I think the general public will actually start seeing the effects of commercial real estate, and that's probably going to be the most dramatic effect at this point.
This post-COVID, stay at home, work at home, hybrid, is it going to ultimately go back to normal, or do you think that there's going to be this permanent excess capacity in office where before it was never contemplated?
I think there's going to be a focus to come back into the office, but I think for a number of different reasons, and your firm's probably more expert in this than I, we have a smaller workforce generally. I think companies are going to downsize their footprint overall, but I don't think it's solely due to the hybrid workforce, stay-at-home workforce. I think companies are going to mandate workers come back into the office, but they're still not going to need the same amount of space that they once did. Another reason is, and this cycle, again, this is where people tend to sort of have a blind eye to commercial real estate and companies. When the economy is on steroids, as has been the past 10, 15, 18 years, companies are less sensitive to office space overhead, right? They're able to produce goods and services. They're charging what they want for them. That's changed. Companies can no longer produce their services at the same rate and at the same price and profitability. So now office space overhead is very, very, it's a very important line item to focus on.
Yeah. So I guess going back to what you're talking about, the loans, I want to make sure that we totally understand the magnitude. And I think my first downturn was in the late 80s, to date myself.
Yep. I remember that one too.
Yeah, no. So when you talk about that people may have issues servicing their loans, kind of walk me through what the butterfly effect is that throughout the industry and the economy as that happens.
Sure. So when a bank lends on a commercial property, it will lend as a percentage of the value of the property at that time, and it's 65 to 75% typically of what the agreed to value is of the property. When that value decreases, as it has today, that loan is no longer necessarily within its covenant because the value of the property has changed. So while that lender or the borrower may be paying the loan and the loan may be current, technically it's out of covenant, and the bank may have to carry that as a non-accrual, meaning it's technically a bad loan, even though the borrower may be paying on it. And at some point, the bank may be forced to go to the borrower and say, you need to actually pay more equity to get your loan back in covenant, or we're going to have to force an action, a deed in lieu or something like that. So that's kind of an oxymoron where people think, well, the loan's being paid, so it's fine, but technically it's out of covenant, and it may be a loan that needs to be foreclosed on or some actions taken by the lender. Yeah,
it's funny because if you look at the commercial banking data, it's really interesting. It shows that there is an enormous spike in commercial real estate delinquencies, but as you said, they haven't been written off yet. So it just means that there's, as we view it, more pressure in the system that at some point it's going to rear its ugly head. But right now, it's just that whole issue is just being kicked down the road a little bit. But
it is. And also, if you're a lender, when you look at that loan maturing and you're trying to decide, or you're trying to determine what is the future of that loan with the current borrower or the future borrower, again, you go to the dynamic that says, well, I'm going to have to increase my interest rate, and the net income on that property is probably going to go down. So that's also contributing to a decrease in value.
And then also, I suspect that as the banks are feeling the pain with their existing portfolio, they're probably tightening a bit on chasing new opportunities.
They are, and as you're, we all recognize that there's been a 2 or 3% increase in interest rates, but also what's happening is amortization periods are shortening, loan to values are coming down, so the whole industry is tightening. There's a lot more scrutiny. Banks are still pressured to make commercial loans, but it's much more difficult for them to do so.
Yep. Yeah, it's I don't mean to sound non-surprised, but when you've been through enough of these downturns, it's the same thing over and over again.
Over and over again. Right.
I guess the good news is by having gray hair and some battle scars, you have that perspective that you can share. Because I always kind of feel that for the people that just got in the industry within the last 10 years, it's been a pretty easy ride because the values have gone up, everything has stabilized, everything has worked, notwithstanding the COVID blip. So, I mean, it's an interesting time. You have a whole generation of practitioners that haven't lived through a downturn. So it's interesting times for them because it is the unknown for many of them.
Absolutely. The other thing, the dynamic that I don't think has been addressed generally is for the past 10, 15 years or so, many folks have used their commercial real estate like an ATM. With a low interest rate environment, you can continue to refinance on a tax-free basis. And there has been billions of dollars of liquidity taken out of commercial real estate, put into the general economy. That dynamic's now changed for the foreseeable future because the situation's inverted. Interest rates are higher. You can't do that.
So I guess with the deteriorating markets, I can harken back to a quote I was told in like I'm not going to say the date, 80 something before the first kaboom. I was talking to a commercial real estate lender and he told me the famous phrase, "You can't get hurt on dirt." I would suggest that maybe that hasn't held true over the last 35 years.
No, I would tend to agree with you. Yeah, that's
or Mark Twain saying, "Invest in land. God's not making any more of it." I guess
that's right. Well, people tend to forget that this, like everything, is always cyclical.
Yeah. So I guess what's really interesting is that rather than saying the sky is falling, I think that there are potential opportunities when the market gets soft or when there's dislocation for a certain class of savvy investors. It's a great time to jump into the markets. Is that right?
Correct. And I think so many people are waiting for, the auction, if you will, of commercial real estate. Where we're seeing some opportunities is in the acquisition of commercial notes from banks. And, if you can buy a note that at a slight discount, you can then work with the borrower to perhaps restructure the note. Or if you have the right real estate infrastructure in place, and if in fact you have to step in and take the property deed in lieu and reposition it, that's a terrific opportunity if you can do it to then create some value for the asset. So they buy notes to sell them and they'll sell it at a reasonable discount. Where there's another opportunity is, and we have a strong practice that works solely with tenants as well. So if you're a tenant in an office building and you've got reasonable size and you're looking to downsize, reduce your rent, do something, and you've got a lease that's coming due in the next 2 or 3 years, you may be able to work with that owner and extend your lease, but yet downsize it, reduce your rent, because the extension of your term adds stability to that asset. And if you're willing to go past that note maturity date, the owner of the real estate may be willing to do that. So that happened again. We did a lot of that back in the early 90s, back in 2001. And that's a good opportunity for a company that leases space to reduce their overhead. If
you're a tenant that's having issues, how flexible are the landlords? Because they want their money. I think they have to be realistic about what's happening in the world. But are you finding that now they're exercising the rights more aggressively, or are they potentially willing to play ball just to kind of keep things as positive as possible in their portfolio?
It all depends on the ownership structure. If you're a REIT and you're driven by quarterly returns, you'll probably have your building financed differently, more institutionally. You may be, a little less flexible. If it's a building that's owned by a local entrepreneur, financed with a bank, they could probably be more flexible. So when we're working with tenants, the first thing we do is we pull apart the capital structure of the building to find out who's the owner, what's their equity, what is their exit strategy. Each building's different.
I guess the last question I have, and you're touching upon it, is there are a lot of folks that are in the real estate markets that view their liquidity as binary. I either have bank financing or I don't. And I know what the answer is, so this is a leading question, but tell me about the liquidity that's out there to support real estate transactions beyond just banks, and that could provide some peace of mind for some people that are having trouble solving for what a bank will let them do.
Well, if you set aside all the conventional, lending sources, banks, insurance companies, pension funds, et cetera, there are a number of funds out there that are available for mezzanine financing. Some are, private equity type funds that have been raised to do this. Some are companies that's what they provide. It used to be more expensive than bank financing. Now it's essentially almost on par where bank financing is. And, again, they can be a little more flexible. That tends to be, gap financing, as we refer to it. But there are sources out there that if for some reason conventional financing doesn't work, there are other sources out there.
Assuming someone does need those services, can you please just kind of lay out your website so that our viewership can reach out?
And there are two practices. So you'll see the company website, and then the practice that I run is called Legacy Real Estate Advisors. And so all our information is there, and you're always available to come in, assess a situation, and give an honest opinion of what can or cannot be done. And we're happy to help in any capacity.
That's awesome. And just so you know, these are the sort of conversations Don and I have all the time. This one just happens to be being recorded. But Don, thank you so much for your time, and hopefully everyone found this as helpful as I did.
Thank you, Ken. I appreciate it.
Thanks.